Yesterday I engaged in an online conversation where I got a little worked up about the tendency of salesmen, particularly those who sell investments, to create the illusion of easy gains and the tendency of individual investors to buy into the illusion. This is a hot button topic for me because I've seen firsthand the damage that this has done to some late in life investors, and I see a crisis emerging on a larger scale for the Western world in general. These people who make their money by selling dreams are predators. The best way to fight them is to understand the nature of their sales pitch and the emotional response that is within us all that makes us susceptible to their tactics. And believe me, they are just as prevalent in the world of precious metals as they are in the world of stocks and bonds. So what I'm about to discuss should be useful to everyone. Bear in mind though, the following discussion is not going to be very sexy. It's much easier to sell a dream than it is to sell discipline. I have no dreams to sell. In fact, I have nothing to sell. My interest is in sharing ideas. So with that said, let's get to it. Let's start with a discussion about risk and why it's so important to avoid big losses, especially late in life. Let me introduce the concept of human capital. Human capital is the potential for each person to generate an income over his or her lifetime. Early in life, people tend to have a great potential human capital. They have a long lifetime ahead of them in which to earn an income, and their opportunities for advancement are fairly high. Mistakes early in life are fairly easy to make up for. Over time, however, a person's human capital will gradually decline. Each year that passes represents more income that was generated in the past and less income that will be generated in the future. Eventually, a point is reached where a person just can't work anymore. This point in time will vary from person to person, but everyone has a point in their life where they will just not be capable of continuing to work full-time. In the latter stages of life, when human capital is low, it is critical to avoid mistakes because big losses just cannot be corrected as easily as they are early in life. In this chart, I've shown in blue what I think is a typical curve for the average person who graduates with a college degree. Your curve may be different depending upon your circumstances, but the principles will be the same. This person will graduate with an income of $45,000 per year, will pay an effective tax rate of 15% per year, and will see real inflation-adjusted increase in earning power of 1% per year. Note that this person starts his or her career with a human capital of just over $2 million. This is the amount of their after-tax salary that they can expect to earn over the span of their lifetime. I've assumed that this person will retire at age 65, and so the curve gradually decreases to zero as age 65 is approached. This person saves 20% of his or her salary and manages to put it into an investment that earns a real rate of return of 2% per year. In other words, this person is quite conservative and wants to avoid taking big risks that can result in big losses. Over time, the person's savings grows as a result of continuous savings as well as continuous returns on the invested money. So, when age 65 is reached, the person has about $600,000 in inflation-adjusted funds to spend in retirement. This is just about enough to fund a 10-year retirement. And it's just about the right amount, and since there's very little risk has been taken, there's a high probability that the person will not suffer a catastrophic loss when the funds are needed most. But let's see what can happen to a person when their assumptions change. Let's add a curve for the person who buys into the dream of a risk-free return. It's the something-for-nothing dream that the investment salesmen love to peddle because it's so attractive for obvious reasons. Suppose a person assumes that the real value of his or her investments will increase by 8% per year. This is actually a very aggressive assumption, but it pales in comparison to some of the dreams that have been sold by the financial investment community. For example, in the late 90s and early 2000s, we had stockbrokers tout returns of 15 to 20%. Most pension funds now assume an 8% per year rate of return for their mix of stocks and bonds, which seems a little ridiculous to me given the low current yield on bonds. Even in the metals market, people are implicitly buying into the possibility of high returns, whether they realize it or not. How often have you heard it stated that silver is going to hit an inflation-adjusted price of $100 or more? Well, that's a five-fold increase in real value from current pricing. So even if it takes 10 years to get there, that's a 17% per year rate of return. Now, I'm not saying that it's not possible. I'm only warning about the risks to your own financial future of taking it as a given. So you can see on this chart the impact the return assumption will have on behavior. If a person believes that an 8% per year real return is realistic, then that person will come to the conclusion that they need to set aside a smaller portion of their income as savings. In fact, here we can see that the person who gets an 8% return can save only 5% of their income and actually come out ahead relative to the person who only got a 2% return and saved 20% of their income. Who wouldn't want that? You can enjoy a higher standard of living during your working career and also have more money to spend in retirement. And this is why the dream of high returns is so attractive and so easy to sell. But there's a catch. What if the person who counted on that 8% real rate of return reaches age 60 and then finds out that the return that they thought that they were getting suddenly didn't materialize as they had planned? Suppose that suddenly this person found out that instead of having $600,000 to $700,000 to spend in retirement, they only had about half of that. There's really not much human capital available to make up for such a shortfall on such a short period of time, and so the person will be faced with some very tough choices. It may mean working much longer than planned, or living a much more meager lifestyle in retirement. Many people are facing this situation now. For example, I've heard reports of average retirement savings of 65-year-olds to be somewhere between $25,000 and $100,000 depending upon the source. How on earth did these people end up in this position? Let's take a close look. Here I show a price chart of the S&P 500 stock index adjusted by the CPI. Yes, I know that the CPI is a flawed measure of price levels, but it's what is available, so I'm going to use it. A person starting their career in the early 80s, assuming they were of the mind to even touch stocks at that point, would have seen a price increase of 11.3% per year over the following 16 years. Of course, most people didn't hop on board until the late 80s and early 90s, when stocks seemed to be like the sure road to wealth, a message that the financial industry was more than happy to promote. So the believers in the stock market would have assumed some very high returns on their stock investments. This resulted in a record low level of deferred consumption, which, by the way, also helped to increase corporate profits, and it reinforced the trend. So going into the 2000s, our investors weren't really saving that much. They were simply assuming that growth would do all the heavy lifting for them. But then we went into a weak decade where we had a couple of significant stock market corrections. Each time the investment community convinced the individual investors that the weakness would be temporary and that it created a buying opportunity. And each time, the market actually rebounded and supported that message. But look where our investors are at the beginning of 2014. The total yearly return averaged over 30 years, despite the massive stock market run that we've had since 2009, is only 5.6% per year, which is a far cry from the original 11.3% per year, plus dividends that the individual investors had learned to take for granted. And what will happen if we have another stock market correction now? I hate to think about the impact that it's going to have on even the current meager level of savings of the baby boom generation. But the main message here is that optimism born from the assumptions made over the past have resulted in undersaving. Now that we have a baby boom generation nearing retirement, it's too late for them to make up for disappointing returns. And believe me, the investment salesmen aren't going to dig into their own pockets to help. Since you're a subscriber to my channel, that probably means that you're a precious metal investor. And so you're probably wondering what this has to do with gold and silver. Well, let's take a look. Here's just one prediction that was put out by a well-known person in the precious metals community. It seems like an attractive message. Certainly those who would like to save money for the future will be enticed by it. Will the prediction come true? Maybe. Will I be staking the financial future of my family on it? No. And why not? Well, it's because the same logic is being used to predict $200 silver as was used by stock market salesmen in the 1990s to weave an illusion of guaranteed high returns in the stock market. That didn't work out very well for those who took the bait. Are this person's intentions well-meaning? It's quite possible that they are, but I'm a little skeptical about the choice of language in this article, the bolding and the coloring of the text, and the fact that this person also sells a silver round. Certainly some caution is warranted. What is most lacking is the stated minimum rate of return that can be counted on for the purposes of financial planning. After all, I'd rather save too much and be pleasantly surprised later than save too little and have little recourse if the results promised do not pan out. And this brings me to something that I would like to clarify about the presentations that I've been giving on gold. I would like to make sure that nobody gets the wrong idea and undersaves as a result. I've discussed in my videos gold presented from two different angles. There's gold the commodity and gold the money. I've often focused on one or the other in my videos, but rarely discussed them together. The danger this creates is the possibility that a person will be attracted to the more appealing of the two views and ignore the other. So let's discuss the dual nature of gold a little bit more thoroughly. For the past 45 years, gold has traded like a commodity. Its price has trended very reliably against the price of oil, and so gold can be thought of as a sort of proxy for energy. This makes sense because gold is one of the most energy-intensive commodities to produce. We can see here that for 45 years, the purchasing power has fluctuated between 10 barrels of oil per ounce and 25. This provides us with a fairly useful tool for figuring out if gold, the commodity, is likely to be underpriced or overpriced at a given point in time. It is the bottom of this channel that gives us the opportunity to manage our downside risk. Now, gold the money is a different animal, whose nature will only come out in the event of a credit system implosion. One that I expect to happen at some point in the future, but I have no idea when in particular it should happen. Gold the money hasn't existed for more than a century because even when it was coupled with the monetary system, it was expanded multiple times via credit denominated in gold-backed dollars. If gold the money comes back, then gold will be valued very highly. There are currently 5.1 billion ounces of gold held in stockpiles around the world, 80% of which is in private hands. The $6.9 trillion worth of gold in these stockpiles is held generally by a very wealthy set of individuals who have a keen interest in managing their downside risk. These people want to keep what they have more than they want to grow what they have. They are the masters at managing the downside. Because gold has a rich history of being a focal point as a store of wealth, I believe that in the event of a credit market crisis or a collapse, gold will be revalued upwards greatly to replace the wealth lost in the credit markets. After all, the same people who hold the gold also hold the $223 trillion worth of world debt. The only way for the debt to be wiped out completely without destroying the wealth of the world's most powerful people, something else that they own, needs to be revalued upwards. Hence gold. It is one of the only fungible and tangible items in existence that can be valued at an arbitrarily high level without it adversely affecting one or more industries. I'm a firm believer that one day we will see this massive upward revaluation to the point where the common man can once again no longer afford to buy gold. But despite this belief, I set my expectations based upon gold, the commodity. This way, I'll be far more certain to realize my savings goals with the chance of being pleasantly surprised if the revaluation occurs within the next few years. Managing downside risk is simply a matter of buying gold towards the lower end of the established commodity channel. I've had good success focusing my purchases at prices that are under 15 barrels per oil per ounce. This limits the risk of disappointment on the downside, but it leaves plenty of potential for upside that can be taken advantage of if and when it happens. And by the way, 50-ounce lots of silver also tends to follow the same commodity channel as gold, and so adding silver to the list of metals that you're willing to buy provides some added flexibility for when gold is on the expensive side. I've used this to my advantage on many occasions, and it's worked out pretty well to accelerate the rate of my accumulation of metals. But there is another downside that a precious metal accumulator needs to keep a close eye on, and that is cost. Because it is easily calculated and easily avoided, and can be also very large. In this table, I'm going to go through a few examples to show just how important costs can be. Let's start with a very extreme example of someone who buys a single silver panda at a time on a credit card. The total cost will be the $30.20 for the coin, which includes a credit card transaction fee, and is also a higher price due to the small quantity. Then we add to that a $9.99 shipping charge. Your charge may be more or less depending on who you buy it from, but in this case, let's use $9.99. Then there's tax. I happen to live in a high tax area where I would pay an extra $3.52 for the coin. So the total cost to me of buying this coin would be $43.71. You should do this exercise for yourself with your own broker and your own personal circumstances to adjust the costs that you would incur. Now this particular broker will buy back the coin at a price of $25.47 per coin if I sell back in an amount totaling more than $10,000, but probably less if I only sell a few coins. But let's assume that we're selling back in large quantities. So the difference between what I paid and what I can get back is $18.24 per ounce, or about 71.6% of what I can get back for my coin when I sell it. Thus, in order to break even, my coin will need to appreciate in value by 71.6%. Now this is a very extreme example, but it shows just how important costs can be and how much they can hamper your savings plan if you don't keep an eye on them. Contrast this to a situation where I buy a low premium silver bar in quantities totaling over $1,000 and I pay by check. In this case, my price per ounce is much lower at $23.33. I don't pay any tax because I'm buying more than $1,000 worth, and I can spread my shipping costs over a larger quantity. Thus my total works out to be $1,176.49, which is just 9.7% above what I'll get back if I sell. Thus, the silver in this case only needs to appreciate by 9.7% for me to break even. But we can do even better by purchasing a gold eagle coin. In this case, I pay $1,435.39 for the coin. It's not taxed because it's an amount greater than $1,000, and the shipping cost is the same $9.99 as before. My total cost is $1,445.38, which is only 3% higher than what I'll get back when I sell it. Thus the gold only needs to appreciate by 3% for me to stay even in dollar terms. So we can see from this example just how important costs can be. Pandas may appreciate more than silver bars, as other semi-numismatic coins may do, but in this case it would have to be by quite a bit in order to recoup the costs. So the general rule here is to try to avoid sales tax if possible, if it's possible to do that by legal means, that is. Pay by check to avoid being charged a credit card transaction fee, and make larger purchases if possible to spread shipping charges over a large amount of metal and possibly get a quantity discount. These are very real costs, and what's more, they are costs that can be avoided. Many people calculate costs based upon the amount that they are spending, but I prefer to look at it in terms of the cost as a percentage of the value that can be realized when we sell them back. After all, our goal isn't to spend value, our goal is to preserve value. And so our costs really should be measured relative to what we are able to preserve, not what we spend. So my advice to avoid disappointing results when you are investing in precious metals is this. Consider your emotions when you go to make a purchase. If, in your mind, you are thinking that you are going to make a killing, then there's a good chance that someone else is going to make a killing off of you. It's okay to purchase coins that you like for personal enjoyment, but if you are doing this for investment purposes, it's best to be as unemotional as possible. Emotion is a danger sign that what you are about to do is going to hurt you. Next, you want to pick times to make your purchases for when there is evidence that the metal is historically cheap. I've provided you with one concrete metric here, and that is the valuation relative to oil. There are others that can be used, of course. Salesmen tend to come out of the woodwork when the metal is expensive, and so listening to salesmen is usually a way to guarantee that you'll be buying at a high price. Avoid paying heavy premiums for numismatic or semi-numismatic coins unless you absolutely know what you are doing in this area. I'll be the first to admit to having no talent for recognizing what specific coins will appreciate in value, and so I personally tend to stay clear of them. There are others who do quite well though, and so with the right knowledge, the premium may be justified. You'll also want to set realistic expectations when you do your financial planning. If your plan counts on a high rate of appreciation per year, then there's a good chance that your plan just won't work. Set your expectations low to guarantee success, and then if your expectations are exceeded, you'll be pleasantly surprised later. Most of all, save hard. That way, if you end up ahead of the curve later, you can always cut back and coast a little. It's certainly better than the alternative. You should also seek to manage costs. This means paying in cash to avoid credit card fees, and it means saving up to make larger purchases. This will spread delivery charges over a larger quantity of metal and also give you a chance to avoid sales tax. Depending upon your location, there may be a significant tax advantage of buying one metal over the other. For example, in the UK, there's a significant VAT on silver but not gold. So check your local tax laws. Be familiar with them. Managing costs is one of the single most important things that you can do as a metals investor, and the one thing that is almost totally within your control.